In 2018, as the US declared a trade war and slapped billions of dollars in tariffs on China, Wall Street's biggest names quietly risked $1.4 trillion on Chinese markets, defying political headlines and public opinion. Why did American finance double down just as Washington tried to pull away? The answer exposes a hidden clash between policy and profit that reshaped global power. On March 22nd, the United States Trade Representative invoked Section 301 of the Trade Act of 1974, launching a formal investigation into China's trade practices. The result was swift and sweeping. The White House announced tariffs on up to $60 billion worth of Chinese imports, targeting sectors from electronics to machinery. The official decree cited years of alleged intellectual property theft and unfair technology transfers, framing the move as an effort to protect American innovation and jobs. Within weeks, the administration published a list of over 1,300 Chinese products set to face new duties. The message was clear. Washington intended to apply maximum fiscal pressure, using tariffs as both punishment and leverage. The scale of the first tranche alone, $50 billion in goods, signaled a new era of confrontation. USTR officials described the tariffs as a necessary response to systemic abuses, not a negotiating tactic. The market reaction was immediate. Volatility spiked, and companies on both sides of the Pacific scrambled to assess the fallout. Yet, even as the US government tried to wall off trade, the flow of capital told a different story. The question loomed: with such a direct economic assault underway, why did American finance continue to pour money into Chinese markets? The scale of American financial exposure to China during the trade war years can be summed up in a single number: $1.4 trillion. This figure, while jarring, is not the product of a single ledger or secret memo. It comes from a careful aggregation of three distinct sources: public filings, bond custody records, and index tracking fund flows. SEC, Form 13F and 10K, disclosures from Wall Street's largest asset managers, reveal steadily rising holdings in Chinese equities and bonds, even as tariffs dominated headlines. Data from China Bond and the People's Bank of China show foreign, especially US, custodians sharply increasing their onshore assets, with American firms accounting for a substantial share of a foreign bond market that quadrupled from $200 billion in 2017 to over $800 billion by 2020. The final piece comes from index providers MSCI and FTSE, whose phased inclusion of Chinese stocks and bonds into global benchmarks forced passive funds to buy in, driving mechanical flows that moved hundreds of billions of dollars. Together, these strands form the $1.4 trillion estimate, give or take a 10% margin of error. The number is less a precise tally and more a signal. While the US government tightened the screws on trade, the collective force of the market moved in the opposite direction. The puzzle is not just why the money kept flowing, but how it managed to cross so many barriers in the first place. In October 2017, BlackRock launched a new fund targeting China's domestic stock market, just as global index providers debated whether to open the floodgates. The timing was no accident. In June 2018, MSCI announced it would begin including Chinese A-shares in its flagship Emerging Markets Index, a move that would force trillions in passive funds to buy mainland stocks for the first time. BlackRock's product, built to track these changes, captured the surge in demand as index inclusion became reality. By the time the first phase of MSCI inclusion took effect, hundreds of funds worldwide had to adjust their portfolios, funneling billions into Chinese equities, almost overnight. A BlackRock portfolio manager wrote in a regulatory filing that MSCI's inclusion of A-shares is a structural milestone, creating new opportunities for global investors. The mechanics were technical, but the effect was simple. Every index-tracking dollar had to follow the benchmark regardless of headlines or tariffs. This was the engine behind a wave of capital moving east, driven less by conviction than by the mathematics of modern investing. Bond Connect launched in July 2017, quietly transforming how foreign investors could access China's vast government bond market. Instead of navigating a maze of quotas and approvals, firms could buy Chinese bonds through a Hong Kong clearinghouse, settling trades almost as easily as in London or New York. By 2019, the Chinese government removed the last major cap on foreign investment, the QFYY quota, opening the door for even larger flows. JP Morgan seized the opportunity. The bank expanded its onshore bond trading desk in 2019 and pushed for a majority stake in its China Securities joint venture, a bid approved in 2020. Internal filings from JP Morgan's asset management arm highlighted the shift, noting that Bond Connect made Chinese fixed income accessible at scale and allowed the firm to serve global clients without the friction of old quota systems. For portfolio managers, the mechanics were as simple as a phone call to the trading desk. The market's plumbing, once opaque, had become a high-speed pipeline. With regulatory barriers falling and operational hurdles gone, the logic of chasing higher yields in China was no longer abstract. It was executable, right from JP Morgan's New York office. Goldman Sachs approached China's bond market with a simple calculation. In 2019, Chinese government bonds offered yields around 3.2%, sometimes spiking to nearly 4% on longer maturities, while comparable U.S. Treasuries paid just over 2%. That gap meant an investor could pick up more than a full percentage point in extra income just for moving capital across the Pacific. For a global asset manager overseeing $2 trillion, even a modest 0.5% portfolio shift into China's government bonds could unlock an additional $10 billion in annual yield, without changing the overall risk profile much. Goldman's asset management division, after securing its China onshore license that year, highlighted this math in internal strategy calls. They said the spread is the linchpin, and that if you are not looking at China for the yield, you are missing half the story. The lure was not just about numbers on a spreadsheet. It was about access, regulatory approvals that let Goldman launch local funds and serve both foreign and Chinese clients. While headlines warned of trade war fallout, the arithmetic behind the scenes kept drawing Wall Street deeper into China's markets. The Phase 1 trade deal, signed in January 2020, was supposed to offer relief. Official statements promised a new era of balance, with China pledging to buy more American goods and both sides vowing to dial back hostilities. Yet behind the diplomatic handshakes, the flow of U.S. capital into China barely paused. Even as tariffs remained and enforcement mechanisms drew headlines, American funds kept streaming into Chinese stocks and bonds. The text of the deal, heavy on purchase targets and enforcement language, offered little on financial flows or investor protections. For Wall Street, the agreement was a sideshow. The real action played out in the markets, where capital moved with few obstacles, indifferent to the drama in Washington. Policy had its moment on stage, but the money kept moving, quietly outpacing the politics. Legal scrutiny intensified as state attorneys general launched coordinated probes into Wall Street's China investments. Investigators zeroed in on whether asset managers had truly disclosed the risks tied to their $1.4 trillion in exposure. Those risks ranged from sudden sanctions to the fallout of a Taiwan conflict. At the center were allegations that fund prospectuses and SEC filings downplayed the potential for government intervention, audit restrictions, or even outright asset seizures. One state AG spokesperson said, Investors deserve to know if their money is entangled with foreign adversaries, especially when political tensions could turn portfolios upside down overnight. Securities lawyers warned that under state blue sky laws and consumer protection statutes, each misleading disclosure could trigger penalties running into millions per violation. For firms managing hundreds of funds, the theoretical liability ballooned. A security analyst put it bluntly, if regulators decide disclosures were not forthright, the cost will not just be reputational, it could be existential for some products. Today, global finance still flows where profit outpaces politics. Even as US and China tensions escalate, Wall Street's bets shape the world's economic future, often beyond the reach of any government. In a world wired for capital, who truly calls the shots? Let us know what you think below.